You should be really proud of that 3% mortgage rate that you have. The timing was perfect when you took out that loan, and the market has only moved higher since. But does that mean that you can never refinance or never have a need to refinance? Nope. While having a really low rate compared to the current market can make refinancing not quite as beneficial as it may have been in previous years, there are still reasons that people should and can refi in today's market. So let's take a look at a few. If you have an FHA loan, which has permanent PMI, mortgage insurance, refinancing to a conventional loan without PMI, now that your loan balance and home values have changed since you took out the loan, or even maybe your credit scores are higher, a refinance can definitely save you money. Another reason would be shortening the term. So going from a 30-year fixed rate to a 15-year fixed rate. The best way to save money is to always shorten the term of the loan, even if the rate is a little bit higher than what you had on the longer term. For example, a loan amount of $500,000 on a 30-year rate at 3% has a payment of $2,108 a month, or $759,000 over the life of the loan. Going to a 15-year rate at 4%, 1% higher than what you currently have, gives you a higher payment, $36.98 a month, but you'll only pay $665,000 over the life of the loan, a savings of just under $100,000. Not too shabby. Another reason to refinance, even with a higher rate, would be consolidating a second loan into one new loan. Many borrowers took second mortgages out in order to purchase their homes and avoid a large down payment. I do a lot of those types of loans currently for people. With home price values increasing, they may now be in a position to consolidate both into one conventional loan at a lower total payment. So someone who took out a $600,000 first loan at 4%, a payment of $2,865 a month, and then has a second loan behind that, a 15-year fixed for $100,000 with a monthly payment of $1,100 a year, giving them a total payment of $3,965 for both mortgages. So now let's say they've paid the balances down and owe about $640,000. We can combine those both into one loan for $640,000, even at a higher rate, 5.5%, giving them a $3,600 total payment, a savings of $365 every single month. Again, that's a pretty significant amount of money for most people, and it is a reason to give up that lower rate that you currently have. What about a borrower who has accumulated a lot of new credit card debt? Maybe they were starting a business. Let's say they had a $400,000 loan at 3.5% or $1,800 a month, but now they have an additional $60,000 in credit card debts with minimum payments of $1,800. By consolidating those into one new loan at 6% today, they have a total payment of only $2,750, saving $850 a month from their credit card payments and mortgage payment that they currently have. Again, even though the mortgage rate is higher today than what they had. Finally, another reason that people might need to do a refinance is very simple: divorce. A lot of times couples going through a divorce need to split up their property, and regardless of what the rates are, you have to get the other person off the loan and change ownership. So that's another reason that someone might need to refinance today, regardless of the rate. So if you have any of those situations that apply to you, or you have questions about your current loan, maybe you're just not comfortable with it, you want to change something up, like shorten the term, or you need cash out, whatever the situation is, I'm here to talk through it with you. Maybe I'll give you a different solution that isn't a refinance, but maybe that does make sense. And unless we talk, you won't know. So reach out anytime. I'm here to help, and have a terrific day. Thank you.